VA loan, conventional loan, FHA, USDA loans, jumbo, alternative documentation when you can't prove your income. Which loan is best for you? Today you're going to watch this video and you're going to find out. Let's start with the advantages of a VA loan. First of all, if you're a veteran or perhaps married to one, thank you so much for your service and your sacrifice. Let's start with VA loans. What are the advantages? Number one, no money down. That's a big deal. No down payment, and years ago we had a limit to the amount of the loan. Today, there is no limit. So you can, on certain companies, you might be able to go to $2 or $3 million on a VA loan. Now, a lot of companies, they set their limit as far as what they'll accept as risk at $1.5 million, but that's changing all the time. So if you qualify income-wise for a $2 million house and want to buy it, VA loan's the best loan to do that with. Now, that's the number one advantage. Number two advantage, there's no PMI, no mortgage insurance at all with a VA loan, no monthly mortgage insurance. So that's another advantage. Now, the bad part is you do have a funding fee, and that's a kind of like an upfront mortgage insurance. It's an insurance that the VA has that they charge you for. Now, if you put a down payment down, the amount of the mortgage insurance up front goes down. So it depends on how much you put down. But if you're a disabled vet, 10% or more, or you've earned a Purple Heart, that funding fee is 100% waived. So that's real exciting to us. So we have the lowest interest rates, no PMI, no money down, and the funding fee, you have to deal with it. If you're a disabled vet, again, you don't pay that. Awesome loan. That's probably the number one loan for most borrowers if they're a veteran. Conventional loans. Well, there's some advantages to conventional loans too. First of all, you must have a 620 FICO score. Compared to other government loans, which have a lower FICO score requirement, you must have 620 or above for a conventional loan. Now, you're often going to hear the term Fannie Mae or Freddie Mac. They're almost interchangeable. They're different organizations, but the guidelines are almost the same on just about everything. Now, they both have that 620 FICO score requirement, and they have a down payment requirement. Minimum, usually 3%. If you put 5% or 10%, the more you put down on a conventional loan, the better the interest rate is. So if you have the money, you might want to consider a larger down payment, which obviously makes sense. Now, there is mortgage insurance when you put less than 20% down, the PMI. And there's a couple of things you can do here. PMI, it adds a monthly insurance in case of default for borrowers who put a small down payment. Now, if you have a super high FICO score, you might want to ask the lender, what about a one-time buyout of the PMI? And what is that? It's a lump sum. We put it in your closing costs when you close on the loan, but then you don't have to pay monthly. And there can be advantages to it or not, depends on how long you're going to be in the home and a number of different factors. So there is PMI requirement. However, on a conventional loan, when you reach 20% equity, whether it's paying the principal down or the house appreciates in value or a combination of the two, once you have 20% equity, you can go to the lender and say, hey, I have 20% equity now. Can you remove the PMI? And they can do that. Sometimes they'll ask for an appraisal. Sometimes they'll look at the value and say, he's got plenty of equity, and they'll remove the PMI. That PMI, a lot of people say, I don't want to pay that. Well, say thank you to the PMI companies, or in a lot of cases, you wouldn't be able to buy a house without a 20% down payment. So we have a slightly higher interest rate than on government loans. We do have mandatory PMI less than 20% down. The debt ratios that we work with can go from 45 to 50% depending on your credit. So 620 credit, hey, they might max you out at 45% debt ratio. You got a high credit score, they might go up to 50%. So there's a couple of different things we can do. What are the advantages over the government loans is you can get rid of the PMI. FHA loans. Hey, FHA loans are great for first-time home buyers or even a seasoned buyer who just wants a small down payment. 3.5% down payment on an FHA loan It's not that much money. $500,000, you'd be put $17,500 down. Now, there are other advantages also. With an FHA loan, you can go down like a 500 FICO score. Now, below 580, 579 and below, you have to put 10% down. 580 and above, it's only a 3.5% down payment. Now, there is mandatory mortgage insurance, okay, PMI. They call it MIP with an FHA loan. Now, there's a 1.75% upfront that they finance into the loan. So if you're buying a home for $500,000 and your loan amount is $482,500 after the $17,000 $500 down payment, they're going to add 1.75% of that loan amount for what they call an upfront mortgage insurance. And then you're going to pay about 0.55% every year. This could change. So, this is 2024, 2025. The numbers could change, but we're looking at 0.55% as far as mortgage insurance. That is mandatory. And when I say it's mandatory, you are going to pay that for as long as you have that FHA loan. If you ever refinance, then you don't have to pay it anymore. But in that FHA, that does not go away. Now, if you put 10% down, the PMI is going to be 0.5% instead of 0.55, a very small difference. However, after 11 years, the mortgage insurance will go away. That's with a 10% down. Now, keep this in mind. That just works with FHA loans with the down payment. But if you put a 3.5% down payment or less than 10%, if 20 years later you have 80% equity, that PMI is not going away until you get rid of that loan. With FHA also, the interest rates are government loans. They are amongst the lowest in the industry. Now, FHA is actually not a loan. FHA insures the loan. HUD owns the Federal Housing Administration. They insure the loan. That's what the PMI is for. That's what that upfront mortgage insurance for, is to help insure the loan so that middle-class buyers can buy a home. Hey, USDA loans, zero down loan. Now, it's meant for middle-class families. There is an income limitation, which we can easily figure out based on the county you want to buy in. We also have to check the property address to make sure it qualifies. Now, 97% of the U.S. landmass does qualify. If you're in a major city or close to a major city, the property won't qualify. So we have to take a look at that, number one. Now, since it's a government loan, it's amongst the absolute lowest interest rates. We do have mortgage insurance. It's cheaper, the mortgage insurance, both the upfront mortgage insurance and the monthly. It is cheaper than FHA, so there's an advantage there. It's a phenomenal loan, and there's one other advantage that most people don't know about with the USDA loan. If the house appraises for more than the purchase price, that amount we can also finance for closing costs. As an example, if a house sells for $400,000, to be an example, and the purchase contract, the deal is $400,000, and the appraisal comes in at $410,000, we could finance that $10,000 as closing costs. So that's a phenomenal deal. That's really just great, and it's one of the best loans in the industry. I love it. Jumbo loans. Once you go above the conventional loan limits or USDA loan limits, assuming you're not a veteran, above the FHA loan limits, you need a jumbo loan. Now, obviously, you have to have the same qualifications, maybe even a lower debt ratio allowance, but the big kicker is you must have a bigger down payment. They're not doing a 3% down jumbo. Now, today's day and age, there are great programs which are less than it used to be. Years ago, it was 20% down minimum. Hey, there's 10%. Once in a while, there's a 5% down jumbo. Now, they do have higher FICO and credit score requirements. So, full documentation loans, hey, we can go up to $5 million. Okay, so alternative documentation loans, what is that for? That's for people who can't prove their income. Why can't they prove their income? Well, a lot of times it's self-employed people. Their accountant writes off everything, and there's basically nothing left to prove income. So we have 3 different kind of programs. There's many, many more, but we're going to talk about just 3 of them today. Number 1 is alternative documentation, such as bank statements. What do I mean by bank statements? Well, give me 12 months bank statements. Could be business and personal, sometimes just personal, sometimes just business, but we look at how much money is going in the bank, and we use that as a guide to figure out what your income actually is. Now, we do that. Now, expect, since you're not really proving your income, you're going to pay a higher interest rate. All these programs, alternative documentation, you will pay more. Expect to, because you haven't paid the taxes, you're going to pay it somewhere. So, alternative documentation for bank statements. Number 2, no documentation. What do I mean by no documentation? Well, we need, again, a higher down payment. All these programs, they're not going to be 3% down. They're going to be a minimum of 10. No documentation is a minimum of 20% down payment. And what do I mean by that? You give a bank statement. You're going to give, obviously, identification to prove who you are, but the bank statement has to show you have the full down payment, you have all the money for the closing costs, and you have adequate reserves after you close that loan, so you're not down to 0 after you close. And that will be the income requirements. Again, higher interest rate, higher risk for the lender, so you're not proving your income. Now, the 3rd program, we call it DSCR program. And what that is if you're going to buy a rental property but can't prove your income, what do? The appraiser is going to say the rent on this property should be $3,000 a month. And as long as the payment, usually about the same, there's different programs, but about the same, the payment's less than $3,000 a month, you'll be good. Now, all 3 of these programs are going to require higher credit scores. You're not going to get these with a 500 credit score. That doesn't exist in these. You're going to probably be at 640, 680. Some of them are 720, some of them are 760. It depends on which program it is. Now, your mortgage professional, hopefully you can call me, we're going to help you figure this out, which program is right for you. Now, we have the government loans. We have conventional. It's not a government loan, but it's kind of backed by the government. We have conventional, we have VA, we have USDA, and FHA. They're so flexible. If you could prove your income, you got to prove your income with all of them. They're great interest rates. They're amongst the best in the industry. Then we have the alternative documentation. And hey, you're in good shape. All you have to do is make a decision that you want to fire your landlord, and in the DSCR program, maybe become one. But we'll do this for you. Just reach out to us, and we're going to help you make a difference in your life. Let's fire your landlord.